Hello and welcome to our bi-weekly Gentian webcast. It's good to see you this beautiful 70-degree summer day. What I want to do today is just open up and do a little housekeeping, which typically my team gives me so that we can make sure that we are all set with some of the things coming. What I want to do is, first of all, thank you for those who've been returning the questionnaires, the Get to Know You Better questionnaires. I know some of you have put some real thought and effort into those, and it's great when we're doing your appointments. I love referring back to those and going, I didn't know your favorite color was lime green. It's really kind of cool to see some of those different answers as well. Also, a couple of different things I think that are interesting as well as we have keep an eye out for your online appointment scheduling. They're sending those out batched via email. So we've changed that to make it more convenient for you to actually do your scheduling of your appointments online. So please keep a lookout for that piece as well. Our next webinar will be August 19th. We wanted to make sure we know that it's every 2 weeks now, and many of you have seen that as well. I know a lot of you don't watch them when they happen. You watch them once they're posted, which is just fine as well. Also, save the date. We have a women's gathering on August 26th at 10 a.m. And that's for any of our female clients. That's run by our team here. The ladies love having the program. It's great connection, and everybody's given wonderful feedback from that one so far. So if you can join them, there'll be an invitation coming up to follow, but that's August 26th coming up in just a couple of weeks. One thing I wanted to start out recently is it's really interesting, but with everything going on, there was a recent J.D. Power survey. And with this survey, what they found is that 31% of clients have not heard from their financial advisor in any form since this pandemic. Think about that. My statement is, really? That's 1/3 of people haven't heard from their advisor. It's crazy. I know from you, we're always concerned about maybe talking too much to you and giving you too much information, but anyway, I thought that statistic was absolutely alarming. So interesting piece as you go, and I just said, are you kidding me? Are you kidding me? One thing I wanted to do as well is go through a couple of different items. So just the last 2 days, we've been recording some great pieces that you'll see here. A master class or retirement class we'll be doing. We spent 2 days. Ken did some of the planning that we'll want to do in advanced planning with people and recorded those. And then Zach recorded some of the fundamentals. And we'll be putting those together. So you should see those coming out in the next few months. They're both for you, your family, relatives, but most importantly, it's to give a master class on retirement with some of the things we've learned over our career and that you've shared with us as well. So that was an awesome thing as well. But one thing during that, what I wanted to make sure of is we want to look at care and how can you care for somebody else, or how can you give to an organization? It's an acronym we call TEARS, T-E-A-R-S. It's time, energy, attention, and resources. So the key is for you to give any of those. What's first and foremost? You have to stay healthy. So we're going to look at a couple of those different ideas today as some of our mindsets and some of our focus. But there's also a lot going on right now with questions and behavior in the market. It's going to be a focus of ours as well today, is behavior. And it's going to be behavior of both clients, but also those people you're going to be talking to that are out there as well. Friends, relatives, your neighbor is going to start giving you great advice about how high the market is and what you should do to get out of it. And then what often happens is they're relayed to us. So I want to make sure we address that with you as well. We've been addressing it on the phone, so it's something that we do want to bring up as well. So as we go forward, that'll be part of what we've talked about too. One thing I want to do as well, we talked a little bit about mindsets in the past. Let me just reiterate those before we go into a bit more of our program today. But we have some mindsets that are very important. And what we found is from our retirees that report a lot of satisfaction and really feel like they're optimizing their retirement, these are some of the mindsets that have really, what I'd say, helped them achieve that. So I wanted to share those with you. Mindsets are really ways you think about things. They're not permanent. They can be changed, but they help to give you a filter when things come in about what you do with them. So the first one was gratitude. That was number one. We normally go big in this, and I was going to go big after this, but I wanted to share this gratitude piece as well. So gratitude is, what are you grateful for? The next one is trusting. I found over time that people tend to trust first, not trust always and never understand that you've been maybe mistrusted, but trust is also another. Another one is being positive. It's more difficult to do in times like this, but if you can turn even this into more positive, like, listen, there's a lot going on, but there's some great things that have changed. Contribution mind, so looking at a way that they can make a difference and contribute, if you will. They appreciate, so looking at things and appreciating them, and also being vocal about that appreciation. Hey, listen, you did a great job of service for me. Thank you very much. That's just even when you're in the line at the grocery store. People need to hear that, and the world is better for that. Abundant-minded, they understand that the world is preferring more and more abundance, and that we're able to provide things in a different way than maybe the scarcity mindset that we had in the past. Another one is loyal. Loyal is also a big one, and maybe an advocate for things that they're loyal about, their favorite restaurant, their favorite movie theater, their favorite service, their favorite advisors maybe as well. They're also open and sharing. They're willing to share some of those really vulnerable places that allow us to understand them better. That's a big one as well. They have faith in the future. They're optimistic. They can see what's occurring, and then they are lifelong learners. So those are some of the mindsets that we want to share with you that may help you. If you're looking at your own mindsets, you might want to take an interest inventory for yourself and go, yeah, I'm there. I want to work on one or two of these. I thought I would share those out with you as well. Because one thing that mindsets help you do is they actually help you control how you think. So the biggest thing I'd like to say this is controlling your own mind. So how are you with that? How's that going for you now? I know it's very difficult. It's frustrating now. We've been under this kind of an idea of fear and pandemic for almost 4 months, if you will. And it's getting a bit long in the tooth for some, but I think controlling your state of mind becomes extremely important. So one thing you can do to do that is look at a book like The Power of Now by Eckhart Tolle. He's got a very heady way of doing it, but you want to take it just in bites and excerpts, because it's a good piece to start to look at how can I have a clarity of mind or peaceful mindset, if you will, as well. Or take a few moments to get an app like Calm, C-A-L-M. It forces you several times a day to just reduce your stress and take a look at focusing on something and clearing your mind. There's enough coming at you on a constant basis. Also, once you're in retirement, clients have reported they have a lot more time to think and worry about different items, friends, relatives, family, news items as well. So one thing I do is every few moments or a few times a day, I'll take a moment and I'll say, how am I now? And what that does for me, it gets me to stop thinking about all the stuff I may be worrying about and focus on what's happening right now and what's most important. What can I do next? Because you can only do one thing. So I just wanted to share a few of those in the beginning, or what I call mindsets and perspectives about what we do. And I did skip gratitude today at the beginning. So make no doubt, go ahead and take a moment if you have right now to think and sit back and think about what you are grateful for. So one of the things I'm grateful for is definitely the reorganization of time. What I was spending my time on before and what we're spending it on today. A lot of you also sharing that with us. Also for the team that we have here, for people who do service for us, that do it selflessly. We've got some great clients doing that with, I think maybe Zach and Ken will share with you as well. If not, I will too. There's a lot of really good things going on we want to talk about. So what that is for you, we'll find out. But with that, I would like to maybe see, Ken, how about yourself? How about yourself for gratitude?
Yeah, thanks, Chris. Good morning, everybody. My gratitude is about a month ago or so, we welcomed to the world a new little baby in our family. Not ours, of course, but my sister-in-law and her husband, Joe, brought in little Reagan to the world. So again, another great addition to the family. Maybe that'll take a little pressure off the in-laws coming over to my house. A lot of you that I see know that joke about my in-laws. So maybe they'll take a little pressure off. They can go over to the Wanakee area rather than the Mequon area. So, so anyways, just want to say we miss you all. I got to see a couple of you recently in person, social distancing. We love you guys. We love all of our clients. We miss the in-person meetings. I can tell you that firsthand right now. Zoom is interesting. I miss the handshakes. I miss the hugs. And I look forward to hopefully seeing everyone very soon.
Thank you, Kim. That's awesome as well. And looking, how about yourself, Zach? How about your gratitude?
Yeah, absolutely. Thanks, Chris. Good morning to all of you as well. One goal of my family and mine was we started going on family vacations starting last year. We went on our first one to Yellowstone. This year, we would have liked to go on another trip like that, whether it's to Glacier National Park or some other park out there, but we get the opportunity to go up north together this weekend. So my mom and my dad and I will get a chance to go up north and spend some much needed time together with everything that's been going on with the coronavirus, and just to slow down a little bit. So I'm extremely grateful for that.
Awesome. Thank you very much. I appreciate that as well. Well, as we go into this as well, thank you for sharing your gratitude, and thank you for sharing your gratitude with us. It's been wonderful. You're seeing a few things out there. You're seeing a lot of big box retailers filing for bankruptcy. You're seeing markets at new highs. You're seeing a lot of caution out there about how high things are going. And those aren't uncommon things. We're going to address a few of those today. You're seeing things like maybe Briggs and Stratton filing for reorganization. But there's a lot of things going on in people's minds today. So we want to address some of those as we go forward here. I want to say one thing, though. Think about this. Let's all go back to April Fool's Day. That was April 1st. It was just about in the beginning of this pandemic and right about the market bottom. Think about this. How do you think on April Fool's Day, all those people who liquidated their portfolios, how do you think they're feeling today? Now, they liquidated them with the idea that they were just going to eliminate a worry, right? How do you think they feel today, now that the market's recovered about 82% of its correction or more? Do you think they eliminated that? I don't think so. Oftentimes, making those short-term decisions on a long-term plan turn out poor. This one, maybe there's a future low coming, who knows? But when you look at this, staying true to the plan becomes extremely important. I thought that was a really good point, though. Remember, again, we're not market prognosticators, we're not predictors, we're not market timers. But it's extremely important to look at this and see maybe what some of the people who were bragging about it in April maybe aren't talking about it today. Again, it's one of those statistics that we see. One more thing just on my part, and I'll turn it over to Zach, is really no predictions here, but if you're looking at emerging markets and maybe Europe as well, historically, even banks around the world, they're trading at extremely low prices compared to history. And also, they've dealt a little better with this contagion than we have. Their economies are beginning to recover and respond to this already in an interesting form. So you might actually find over the next 4, 5, 6, 10 years, I have historically found when assets are very low valuation, historically, those tend to be some of the best performing assets over the next decade or so. So there's no predictions to it. It's just saying things that we see, we study. We've been talking about around here at the office as well. We've done a lot of recent study on some of these valuations. And I just wanted to share that piece with you just in the bigger trend. Maybe Zach or Ken will talk a touch more about that as well. But I think the next 10 years, there's something called mean reversion. If this is the mean, oftentimes things that aren't doing well will revert to the mean. If this is the line and things are doing very well, they'll often revert to the mean. So that's why we're also diversified, a big portion of that as well. So Zach, how about yourself? Why don't you bring in some of the market and the market numbers for us, please?
Absolutely. Thanks, Chris. And we'll go over a few things here today regarding the market. We'll talk about year-to-date numbers real quickly with some of the major indexes. We'll talk about since the market peak. We get a lot of questions on since the market took a correction in February, late February, how is it doing now and relative to then? We'll talk about just a few points we've seen in Q2 as far as earnings reports from some of the bigger companies out there. And then also just a few fun facts that we found for positive focus as well. So to start, year-to-date numbers, we'll start with the Dow Jones Industrial Average, which if you remember from the last newsletter, comprises of about 30 stocks covering different industries. And that is currently down 5.99% from the start of the year. The S&P 500 just recently over the last 2 months flipped positive for the year. It's 2.34% up on the year to date, which is kind of amazing to see, seeing the hardships that came initially with the correction. The NASDAQ is actually up 21.94%. Again, that's 21.94% for the NASDAQ, which comprises of 2,500 stocks, and it's heavier weighted towards technology. So that's why that one is a little bit higher than the others. And then since market peak, the Dow Jones was at its market peak on February 12th. It's currently down 9.21% since the peak. The S&P 500 reached its market peak on 2/19, and that is currently down 2.36%, which is really amazing to see. Because if you remember from some of our earlier bull and bear market presentations, most bear markets last over a year, and it's almost flipping towards being out of this initial bear market towards the traditional definition of a 20% correction and reaching its next market high. So as Chris has mentioned in the past, we don't speculate on what that means, but it could mean that we didn't really truly meet a bear market traditionally. And it could be maybe an extended bull market that we've still been in this whole time. So just an observation there. Since market peak on 219, the NASDAQ is actually up an additional 11.45%. So that is interesting to see as well. Just a few things that we saw over Q2 real quickly is that with everything we've heard from, especially from Chris over his Abundance 360 presentations that he's seen and been to in California, he talks about all of the advances in technology that's coming. And one thing that COVID-19 has showed us is that maybe has been accelerated tenfold over the last 6 months. Things like PayPal and Square, companies getting extremely efficient with their business plans and also with real estate working from home. It'll be really interesting to see the advances in technology that are already occurring and maybe have been accelerated. We've also seen a significant drop in GDP, about 32%, which is one of the quickest drops ever, but it was less than what was expected. So that's important to note as well. Some huge earnings by big tech companies. You maybe have heard Apple had one of its best quarters of reporting ever. Same with Amazon and a few others. And same with semiconductors and other technology stocks. One thing we wanted to note is there's been a huge wave of interest in both technology, but also in biotechnologies around vaccines regarding COVID-19. And just to be a little careful with that, because that's where the speculation comes in and could be very wrong, even though performance in the short term could be significantly high and you read about or hear about all the advances in technology and things like that. But that's why we have a diversified portfolio and don't try to chase those things. Real quickly, just switching gears, just wanted to share 2 positive focuses that we've seen over the last quarter. There was 2 studies done. The first positive focus was that there was a study done surveying millennials and Gen Zers, and around 50% of millennials and Gen Zers said they were going to curb spending and save a little more. So just a short amount of time, it showed that COVID-19, everything revolving around it, there's been some learning for some young people as well. So could come out of it much better than they came in it, which is great to see. And also just wanted to mention, based off some conversations we've had with you guys, don't be afraid to share your wisdom with your kids and grandkids. You guys have been through a lot of things in your lives, have learned a lot of things and been through times like these before. And don't be afraid to share them with your kids and grandkids. I know they would appreciate it, and I would love to hear those as well. The second one, real quick, is just a bright spot regarding charitable giving. You'd think that with the economics hardships that we've seen to start the year, that charitable giving would be down, but in fact, it's on pace to be ahead of 2019, and 2019 was one of the biggest charitable giving years ever in the US. And fun fact, I would have thought that most of the charitable giving in the world would have been from corporations and companies out there that, essentially have the most capital to give, but 69% of giving in the entire United States is by individuals. So that's individuals like yourself giving resources, one of the tiers that Chris mentioned, which is great to see. And Chris also mentioned another way to give as well, which is through time, energy, and attention. And we've heard some absolutely incredible stories from clients that are inspiring, whether that's sewing masks for individuals or hospitals, spending more time with their church potentially as well to help hardships out there. And for me, that's one of my favorite parts of working for you guys, is that we hear those and they inspire me to ask the question to myself of, what can I be doing more to help out? So thank you for sharing those. And if you do have those and you haven't shared us, feel free to share them with us. We love those.
Yeah, they're inspirational to all of us. And that shout out is to Connie, one of our clients up in Appleton, as far as making the masks. It's a huge undergoing, but we really want to make sure we give a shout out to her. We didn't ask her beforehand, but I'm sure she'll be okay with that. So thank you very much, Zach. So I want to say something here. You've heard a lot of sayings over time, and they seem like they're quite apropos, and you can use them at different times. But let me make a statement here. Don't just do something, sit there. You're wondering, what the heck is it? And that, don't just sit there or do something. Strangely enough, when it comes to planning, the next section that Ken's going to talk about, the exact opposite can be true. The funniest thing that I've found is you'll see some of these euphemisms. You'll see some of these and say, wait a minute, don't just do something, sit there, that's the best thing to do. Often cases it is. As a matter of fact, when it comes to things like some of the studies we see, those who make more affections and more changes in their portfolio on a constant basis actually perform much worse than those who are patient and let it ride out. At any rate, with that, I want to bring Ken on as well. Ken has some phenomenal pieces to go with in planning and some of the ideas he has as well. So I want to give Ken the microphone.
Hey, sounds good. Thank you very much. So a couple things. I'll talk about the CARES Act real briefly about RMDs. I'm going to talk about the big box retailers a little bit, kind of what we're seeing there. I've listened to a podcast recently. I want to bring some of that information to you. You're probably hearing it as well. Also a little bit on GDP, and I'll end with the Social Security great debates. Because a lot of our clients are retiring right now. We probably have 15 or so retirees right now that are thinking of retiring this year. And so we want to make sure we address Social Security on a mass level. But again, that's an individual type of thing. So a little word on GDP. GDP came out in the second quarter, 32.9% for the second quarter, suggesting that our GDP, the country's output in goods and services, were roughly down about a third lower than the first quarter. When you see that, it's a little bit of an exaggeration because it's 32.9%. They annualize those numbers. So when you take a look at that, it's really more like 9.5% or so. But again, a very big number. Didn't really surpass what we saw back in the Great Depression timeframe, and also back in quarter one of 1958 when we saw when U.S. was ravaged by the Asian flu. So again, big numbers, but again, not as bad as probably they make them sound to be. Also, when you take a look at what the experts say about the third quarter could be up 15% annualized as well. But again, annualized. So that's more like 3.6%. So again, just a little word on GDP and some of the headlines that are out there. On the CARES Act, this is some legislation. This is really around the waiver of required minimum distributions this year. If you had to take one, you don't need to take one. Even if you are not the owner of the IRA, you're the beneficiary or the inheritor of the IRA. If you've inherited one from mom or dad or grandma and grandpa or even a friend, you don't need to take that RMD this year. It's actually been waived. If you did take it, we have until August 31st of this year to make sure we get it back in the IRA. A couple questions on that came up. We've got a few accountants involved as well on how to handle the tax withholdings. So if you have questions on that, I'm pretty sure a lot of you are good on this piece, but just want to reiterate it one more time before the deadline actually happens. So big box retailers, I know I'm going pretty quick right now, but we're seeing some struggles there, filing for bankruptcy and protection. Money's being spent just in different ways in different places right now. So that's an interesting piece to look at. What I find interesting, though, is we're starting to hear what we heard back in the 80s and even earlier than that, is that some of these big companies, it reminds me of like the Bells that got broke up, the telephone service companies, the Bells that got broke up. Big tobacco, was trying to get broken up by Congress and legislation like that. We're starting to see Amazon, Facebook, those actual companies being summoned by Congress to talk about, are they too big? So we're history, again, doesn't repeat itself exactly, but it surely rhymes, and we're starting to see some of that. Lastly is the Social Security great debate. Like I said, we have a lot of clients that are retired, have already taken Social Security, or if they're waiting, there's good reasons for all this. All this conversation I'm trying to bring up right now is to get you thinking about, maybe how to start the conversation in your mind if you're thinking about it. We'll definitely guide you through there, and we'll ultimately end up with the best decision for you. Now, there might be reasons why you're delaying. It might be health insurance. It might be because you're working part-time and you're making more than the amount that they say that we can make. Otherwise, our benefits start to get reduced if we're before full retirement age. So there's plenty of reasons to delay. But here's one. Really the debate is this, is if we wait, but we need income, so we either take money from our portfolio or we take money from Social Security. That's really the debate right now. It's been a debate for years and years and years. Now, what we've heard out there is that there's an 8% increase on Social Security every year you wait. That's true. The next question has to be, though, 8% of what number, right? So let's say, for example, your benefit's going to be $2,000 a month. I'm not going to go too into the numbers right now, but it's a very simple thing to kind of wrap your head around here. $2,000 a month. If we wait, we get an 8% increase, which our benefit goes up $160 per month, or $1,920 more per year. Now, let's say we have $1 million portfolio, and so let's say you average 6% rate of return. I'm just throwing a number out there. That's $60,000 of earnings and potential income that can be used in that year as well. So when you weigh these things out, you know, $60,000 of earnings or $1,920 more from Social Security. Again, it's not that simple, but it really is a good conversation starter. Either we use, you know, the government's money, which is a return of our money from Social Security, or we use our portfolio. It's always been a discussion. So once you've amassed your nest egg, protect it, cherish it. It really is what we call the golden goose. And if done properly, that golden goose will continue to produce the income for a very, very long time, probably even generational type of money if done properly. So just wanted to bring that to your attention. And from a planning standpoint, and I'll kick it back over to Chris.
Phenomenal. Thank you, Ken. I appreciate that. And one thing to remember too, and Ken and I were talking about this as well as Zach and Peter and I, as prices go down, people start to fret. But remember one thing, many of you are value shoppers. What happens to the value of companies as prices go down? As price goes down, value increases. So sometimes these corrections we look at differently. It gives opportunities for managers or people to buy companies they didn't think they could afford before, or fall into areas where they think they're going to get a great value. So very interesting to take a look at. So as prices go up, value actually often can decrease. Also during these corrections we were talking about, during the 2008 corrections, you saw a lot of companies throw a lot of things that they weren't doing very, very, very quickly. They threw them out and they didn't operate on those anymore, and they reemerged in a much stronger way. So those are things that happen in these corrections as well. So a couple things I wanted to do here as well, just to kind of go through and talk with you about is, one thing that we have found is it's been 4 months and a lot of you have gotten out of your routines. I want to re-stress and look at health again, because let me make a statement. There's a lot of people that you can help. There's a lot of people that you can really make a difference with if you're feeling well enough to do so. So I would say let's challenge us to recommit to feeling well. That's both mindfulness, it's eating a diet that's healthy, and it's maybe doing that exercise that you kind of put off because I don't feel like I should go out and do it. To some, this is ramped it up and amped it up. But what's interesting about this is I'd like to make sure that we're healthy enough, because our health, without it, we can't help others. And I know that's what a lot of you love to do. So I want to make sure we take a look at that right now, and we make a redoubling focus on that. Now, there's a lot of things that we look at probably between now and Labor Day. A lot of things going on, maybe even between now and Thanksgiving. I'm going to say there's a lot of things that you can do to help other people. Now, a huge portfolio move is probably not one of the best moves you can make. Why do I say that? With COVID, politics, earnings, and economy, and neighbors and friends, it's starting to weigh on you. And we're seeing that by people calling us, calling myself, Zach, Ken, Peter, and talking to us, and Lisa and Julie, our whole team, and talking to us about, maybe I should make some of these moves. I know that's what it feels like. That's what people are talking about. But what's interesting is most of retirement and investing is counterintuitive. It's doing the opposite of what you feel. That's why I brought that. Don't just do something, sit there. It's probably much more successful than don't just sit there, do something. That's what most of America wants to do and did in this correction. And if the statistics were true, that hasn't panned out very well for them as well. So I wanted to give you two of those. So by taking care of yourself, it's an extremely important piece. I want to read you a little something as well that I'll write. It's probably going to be in our newsletter as well. And it's really inspired by me, by a good teacher of ours named Nick Murray. He writes some great pithy things, but he often writes them in words that are so difficult to understand. I have to get a dictionary out to understand some of the words. But I want to give you just a bit of what that is. The eternal optimism that I am, I'm an eternal optimist, I agree. I believe a lot of good may come out of what's happening right now. Like us realizing that how we spend our time, and maybe how we spent the time and it wasn't so important. So getting together, spending more time with your family, all the extraneous things that you did, we've really taken a look at this and decided maybe this is a less optimal use of my time than it should be. So I think what can come out of this is really the pandemic is kind of breaking those patterns of the way we used to spend our time and refocusing on them on what truly is important. If work wasn't quite as important and you were spending 90 hours at work, maybe you spend 70 or 60, and those extra 30 hours you spend on something else. A striking statistic that struck me recently is of the boomers. This came from a great book called What Retirees Want by Ken Dykewald, but here's an interesting piece. Right now, the average retiree watches 50+ hours of television per week. So that's on an everyday basis divided by, let's call it about 6.5 hours every single day. Now, what if we also add on to that social media, which is 20 plus hours a week or more? What could we do if we were actually out helping somebody during that time? More importantly, helping yourself to help other people as well during that time. I just want to throw those stats out there because you might look at this and go, that might be me. Maybe we just turn off those programs. We amp down that news media feed to us as well. So I believe that we're going to come through this in a lot better scenario. I think we're going to make better choices. We've reprioritized our time. Things that weren't important to us, we've eliminated from us as well. And of course, it all starts here by taking better care of ourselves. I think that's the only way that we can help others out there as well. So I just want to go through this. I think on a daily basis, there's a lot of good things that can come from this. I've reframed it because the world keeps hitting me. And occasionally I think those negative thoughts too. And it's like, wait a minute. I think we're actually going to be better off from this. Now, you can differ with this. I understand it. You've all got different opinions, but I just wanted to offer that. There's some great things to come out of this, just yet to be written. Taking the time to reflect, taking the time to look at who and what is important to you are really two of the most important things. And the third, I'd say, was stay healthy. Stay healthy, especially your mindset. Don't cloud that up, that as well. And more importantly, as the barrage of information is hitting you with corrections, with who's going to be the political candidate, which who's going to be this, you know what we've talked about. And in our newsletter, what we're going to do is we're going to send out you a mid-year letter, and I'll give you just one excerpt from that piece as well, because you know who we are. Our overall philosophy is really goal-focused, planning-driven, and sharply distinguished from the approach that is market-focused, which everybody's talking about, and current event-driven. That is not how we operate. In our experience, we find that many successful investors act continuously on a plan, and many failed investors get that way by reacting to what's happening in the markets. So I'm reading you a little bit. Our overall philosophy, as you know, has always been, it is not market timing. It is not in and out. It is not strategic day-to-day operations. It's focusing on that plan and then prescribing to you the fierce but kind behavioral advice that will help you complete that plan and get to the end. I've got many stories and many clients who followed that, who've been through it 2 or 3 times with me. If you're newer with myself, Ken or Zach or Peter, you may not have experienced a bear market with us before this. This is a different one. Bear markets last much longer than this. They're much deeper than this as well. But there's sometimes more certainty. It's not an uncertainty like a pandemic. It's an uncertainty of something else. So we just want to tell you, we're here. One of the most important things that we want to let you know is, and you've seen that with our communication, in some cases we felt over communication, and you've told us there's nothing to do with over communication. But we're really serious about our guidance to you. When you take a look at what we do, we're committed to helping you, and more importantly, also your family and what's important to you. Wealth management is what we do, but getting through times like this is who we are. You're going to notice that with our team. We've redoubled and recommitted this as well. While a lot of advisors have gone away and focused on themselves and said nothing to people, that is not. We've done the exact opposite. We have refocused. And what I want to do is congratulate this team. The team that we have here has done incredible. They've redoubled their focus. When they've been tired, they've actually put out even more energy and done things to keep themselves prepared for this as well. So I want to give them kudos. They've done a phenomenal job of that as well. And I really want to make sure we give them a hand and give them some strong appreciation in that piece as well, because we know what we're here to do, to help you during times like this. So I want to thank you on behalf of our entire team here. We want to encourage you to stay healthy, stay safe, and stay grateful. Thank you guys very much, and we will see you in 2 weeks. Also be sure to share your gratitude, share your experiences, your positive focus. Those things spread amongst us all. And if it's a great piece of news, we'll spread that amongst some of our clients if that's all right with you, because people love to hear that and they need it. Again, until 2 weeks from now, thank you tremendously from our entire team here at Gentian Financial. Have a great day.